Morning, everybody. Welcome back to Strongman Personal Finance. In this video, we're going to look at a mortgage REIT, a mortgage real estate investment trust, AGNC Investment Corporation. And yes, this is a sponsored video. Why was I compensated for this? Am I going to tell you this stock's going to 10x my index? No, I'm just going to look at the company and look at the financial statements. So, what is AGNC and what is a mortgage REIT? Well, basically, a mortgage REIT is an investment trust, an investment fund that borrows money and then uses that borrowed money to invest in mortgage-backed securities, securities that trade on an exchange or trade in a bond market. And the reason they're doing that is because they want to borrow money and pay a certain amount of interest, and then take that borrowed money and invest in mortgage-backed securities that pay higher interest, and their profit is the spread between those two interest rates. So ideally, you want to borrow money at 2% and invest in a mortgage-backed security at 5%, and you get the spread of 3% after all the other fees that are associated with running a business like this. That's a mortgage REIT. Now, right off the bat, does that sound a little degenerate to you? It does to me. If I was going to be a real estate investor, which I guess technically I am, I have a house, I would just buy a house or buy an apartment and rent it out because I have a solid tangible asset and I don't have to worry about fluctuating interest rates. Once I buy the house, I have my mortgage payment unless I have a loan like Andre Geek has, and then I don't have to worry about it, okay? This thing is degenerate as heck. But the guy was asking, okay, look at the company, just look at the financial statements, and talk about the dividend. So, just reading about the company, they basically describe, what it's all about. They invest in agency residential mortgage-backed securities. So you have agencies like Freddie Mae and Fannie Mac or whatever they're freaking called. And the government is very involved in the mortgage market in the United States. But these are basically mortgage-backed securities that are issued by agencies. So, let's see. Market cap $5.7 billion, total return since IPO, and a dividend yield of 15.3%. This is why people are interested in this stock, because when they look at this, they say, well, you're going to get 15% returns, right, bro? Well, let's look at the stock performance, and then let's talk about how that dividend yield is calculated, because it's actually pretty simple. So we can see over the past 5 years, this mortgage REIT has been absolutely clapped. It's down 48%. Can you think about why this may be? Think about it. What has happened in the last year or two? The Federal Reserve has raised interest rates. That means borrowing costs have gone up. Mortgage REITs like AGNC borrow money, and they pay interest on that money, and then they use it to buy mortgages. Now, if you think about it, if your borrowing costs are up and they hold a bunch of older mortgage-backed securities in their portfolio, they probably have a negative spread. Possibly, probably. And that's exactly what's happening, as we'll see in a second. So the stock's been absolutely clapped. Now, what's going to happen when the Fed cuts rates? Who freaking knows? Maybe the stock will move. I don't know. But this is you got to be very careful with these things, okay? It's not like buying a house and investing in a rental property where you got to worry about, tenants and this and that, because your expenses are a little bit more predictable. Here it's whatever the Fed does. But we can see this thing is, at least from a price action level, has not done that well. Now, here is why the dividend yield is so high. Here's how the dividend yield is calculated. You take the last 4 quarters of dividends and you add them up. So we got 1.44 here, right? Let's go see if this actually ties. Where's the dividends at? I thought I had it on here. Dividend per share is 36 cents. So I did the math earlier. 36 cents per quarter, so every 3 months, times 4 is $1.44 per share per year. From the past. This happened in the past. In the past, they paid 36 cents per share for the last 4 quarters. And if you add that up, you get 1.44. And you can see that's that right there. Then you take the last 4 quarters of dividend and you divide, oops, wrong one. and you divide it by the stock price, which is currently $9.05. And oh my God, you get a 15.91% dividend yield. That's how they calculate the dividend yield. Think about it. That's past dividends. Does that mean you're going to get 16% in the future? I don't know. I think a company that's losing money on interest rate spreads if things continue to stay this way, probably can't afford to pay that same dividend. But we don't know. Things could change. Okay, but that's something to consider. Something to consider. So, we can see, we know what it is. Like, look at this stock analysis ain't going to help you. You can see they have negative revenue. Like, stock analysis is not going to help you, okay? We need to go and look at their actual financial report. So this is their most recent report, released October 30th, 2023. And we're going to go look at their balance sheet. They talk about their earnings, blah, 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 up here, but it's all like gobbledygook and adjusted this and adjusted that. So first of all, we want to see their portfolio. So they have a $59 billion investment portfolio with $55.9 billion of agency mortgage-backed securities. So these are, mortgage-backed securities that aren't as DGen, theoretically. Okay, these are agencies. These are federal government agencies. 2.4 million of net TBA mortgage acquisition. I don't know exactly what TBA is. I think it's some kind of like settlement, mortgage backed security settlement thing. I'm not quite sure what that is, but it's a very small part of the portfolio. I think it's like 2%. So we can see basically the vast majority of their investments are agency mortgage-backed securities. And they talk about it a little bit more here. Let's go ahead and look at their balance sheet, and then we're going to go ahead and look at their income statement. So we can see they've got multiple quarters here from September 30th, 2022 to September 30th, 2023. This is I actually like how they have this set up because you can clearly see trends. So we can see that they've steadily over the last couple of quarters increased their portfolio of agency securities. They've been buying them up. And that's the vast majority of their portfolios. That's probably 80% of all their assets they have. Now, one thing I noticed is that cash and cash equivalents have been steadily dropping. Why? Well, number one, they're losing money from the interest rate spreads. And number two, they're paying dividends. So if you think about it, look at the cash. It's going down and down and down and down. They're going to have to start selling treasuries. They're going to have to start potentially selling their agency securities if they want to keep paying the dividend. You can clearly see the cash going down, and you can clearly see the treasury securities, which is, liquid government debt that you can use to sell and pay dividends with. That's also going down. So their liquidity is rapidly decreasing. So the fact that the dividend looks good in the past is irrelevant to the future. It's all about what do you think is going to happen in the future? What's going to happen with interest rates? Is the Fed going to cut rates? How fast are they going to cut rates? Blah, 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 blah. How's it going to affect this mortgage rate? But I don't know. This is just like a degenerate investment, in my opinion. I don't care what the yield is. So we can see the assets are going up, but also their corresponding liabilities are going up. They have repurchase agreements. They use repos to go ahead, and that's how they borrow money. Basically, you borrow money and then you pay back a little bit more than you borrowed, and the difference is the interest that you pay. That's the repurchase. So overall, their balance sheet. I mean, I'm a little concerned about their liquidity. To be perfectly honest, they're gonna have to start selling stuff, and that's not gonna be good. So here's what I'm talking about. They're getting hurt very badly when it comes to their interest spreads. Interest income, $593 million in the last quarter. Interest expense, $646. They're getting clapped. They have negative revenue. They're getting clapped by everything that's going on with the Federal Reserve. Okay, realized loss on sale of investment securities. That's right. So they hold a bunch of mortgage-backed securities that probably are low interest rate. And when interest rates go up, bond prices go down. So if they have to sell their investments, they're getting a loss. They're getting hit with the loss every time they sell. So they've realized losses, like actual real losses, in one quarter of $534 billion. Why they're selling this? $534 million, excuse me. Why they're selling these? I don't know if it's to pay the dividend or what. But they're getting losses from selling. Unrealized gain on investment securities measured at fair value. So you can see this is a gain that is it's unrealized, which means you haven't sold the underlying investment. Like if you buy a stock and it drops, but you don't sell it, that's an unrealized gain. If you buy a stock and it drops and you sell it, then it's a realized gain. Okay, so they're losing money on their core business, and they're losing money on selling securities at a loss. A lot of their securities are down, and if they have to sell more, that's going to become a real loss. But they did have a gain on derivative instruments and other investments, whatever that is. This is probably a one-off thing. They're losing money. Like, this isn't good, okay? It doesn't mean it's going to go bankrupt, but I'd be concerned about this company. When you have negative revenue, it's not good. So basically, I don't like this. I mean, the only reason people are buying this is probably this. But remember, this is a historical metric. This is the past. This is not the future. You gotta look what's going on in the broader market. You can't just be like, oh, the dividend yield is really good, so I'm gonna put all my money in this stock. I mean, if you want to gamble on this, whatever. You want to put a couple $100, just play around, get your little dividends. Okay, whatever. I mean, vast majority of your portfolio should be in total market index funds. But this is not something I would ever even remotely consider putting a heavy allocation of my portfolio into. But you know me, I'm a VT bussy boy. So that's my thoughts. Hope you enjoyed the video. If you want to sponsor a video, I'll make a video about it. It doesn't have to be about stonks or looking at balance sheets. Or find the balance sheets, as Jeremy says. I'll do any video you want. You send me $50, I will make you a video. All right, guys. Hope you enjoyed this. Hopefully you learned something. I'm just looking at the financial statements. Delicious. And you have a wonderful day. Cheers.